Ladies and gentlemen, please take your seats. The show is about to begin.
This is the Hey Ed YouTube channel, and I am your host, moderator, and all-around nice guy, Edward Anderson. So today I am going to answer the calls of so many people who've been asking me, actually for a long time, to do some videos on trading. Okay, so because the word kind of got out about my trading background, and although my channel is not about trading, they know about my background, and every once in a while, that topic seeps into my commentary and conversations, and people want me to do some trading videos. So, okay, so again, because I'm a giver and I want to answer the requests of my subscribers, I'm going to do one. It might be a two-parter on basic trading techniques, and I'm going to call this series "Trading for Dummies." Okay, and if this is more than one video, this will be part one of Trading for Dummies. Okay, so a little bit about my background. Okay, so I started my career on the stock market in 1987. In October of 87, I became a stockbroker in New York. I won't tell you the whole story because I value your time. Sometime maybe it is kind of a fun story. But I started working as a stockbroker. Then I worked my way up to trader, and then eventually I became a trading instructor. And then I started teaching a class for the general public. I actually designed the first trading class that was available to the public in the country. Now that was in 1997. If it wasn't the first, okay, it was one of the very first. I don't know of any others that were being taught then, but I'll allow for that possibility. But I did not have a roadmap to follow to teach people how to trade, so I had to design a course from scratch. And that first course was kind of brutal because my manual was this big. It was huge. The course went on for 2 weeks, and because I was enthusiastic and I wanted to teach people everything that I knew about trading. And at the end of those 2 weeks, those poor people were just shell-shocked. It was a brutal 2 weeks. And then after the course, I would mentor them. I would help them with their trading. So a day would not go by where I could walk through a trading floor without being flagged down and asked questions about the trade they're doing. Over the course of the years, I refined that course down more and more and more to the point where now I can teach people how to trade in about 90 minutes. This is the manual now. Okay, this is the manual. This is what I got it down to. That's how thick it was. And by the end of my course now, if my students are turning to each other and saying, geez, is that it? I take that as a point of pride because yes, I boil it down to what they need to know. Now when I teach someone how to trade, I do not try to teach everything there is to know about trading. That frankly is a lifelong endeavor. But I teach them what they need to go to get up and running and to start trading successfully. If they never learn anything else, if you learn nothing else, you will know everything that you need to know to trade well. The academic part of teaching people how to trade is not that complicated, at least not now, the way I refined it. The difficult part in trading is the emotional part, the psychological part, the getting to know yourself part, finding what I call your trading skin. Trading is a highly personal endeavor. Everyone can take the academic stuff, but then they've got to make it their own somehow. And that just comes with time on the water, as a sailor would say. You just have to do it. You just have to be in there, making the mistakes, doing the trades, and putting your what you've learned into practice, and then finding your own way of doing it. Now, that doesn't mean that you can break the rule. There are some rules in trading that are non-negotiable, but there's lots of room for putting your own personal stamp on your trading style. So just because I might teach you what I am doing, you may not be successful doing it because you don't have the discipline to do it, or whatever. Everyone's got to find their own personality when it comes to trading. Now, everything that I'm going to teach you in this video refers to all investment, all tradable products, okay? Now, you will often hear me reverting to the word stocks because I'm primarily an equities trader, and all my courses were about trading stocks. So that's kind of in my vocabulary, okay? But the fact of the matter is, these principles apply to all investment products, whether you're a cryptocurrency trader or a stock trader or a bond trader or real estate or rubber dog poop. It doesn't matter. Because when you're trading, you're not trading the product itself. There's your first little trick of the trade, okay? First little insight. When you are trading a stock or when you're trading your cryptocurrency, you're not trading that stock or that cryptocurrency. You're trading people, okay? Now, people are emotional beings. They always have been, and they always will be. So if you learn how to look for the three emotions that drive the markets, you have an advantage. And that's what I'm going to teach you in this course. Now, I try to keep things simple. Now, one of my primary pieces of advice that I can give anybody who's thinking about trading is to find something that works, whether it's something that I show you or something that someone else shows you or something that you come up with on your own. Just find something that works, something that is repeatable, and when you do that, that's when it becomes a business. Now, that can take a while. Now, one of the goals of my course is to shorten that learning curve, get you to that point faster than on your own, just trial and error. I'm going to, toward the end of my course, by the time we're done, I'm going to spoon feed you one or two specific strategies that you could apply right away. Now, you only need one, right? You only need one strategy. Just find something that works or a small portfolio of strategies that work, and then do them every day. If you own a restaurant, you do the same thing every day, right? You open the doors, you mop the floor, you cut up the vegetables. You have a routine, okay? You do the same thing every day. Well, trading is the business, and that's how you want to treat it, as a business. And that segues into my first topic, is what is trading? Well, trading is a business, okay? It grinds my gears a little bit when I hear people always referring to trading as gambling. It's not. If anything, the closest example you can give, the closest analogy you can get there is that you have professional gamblers who know the rules, they're disciplined, and they treat it as a business, versus the weekend gambler who goes to the local casino for fun. And if he walks in with the attitude, well, if I lose it all, it's no big deal. It's just 1 month of rent. So a professional gambler thinks of it as a business. And with trading, you want to think of this as a business, not as something you do on the side. If you want to trade on the side, just don't kid yourself. You're probably not really trading. You're speculating. And there is a very important and a very distinct difference. Trading is a business. Okay, so all right. What's next? All right, trading versus investing. All right, now a lot of people think that trading is about day trading. Well, no, not necessarily. Now, there are a lot of people who do trade within the confines of a day, and they're called day traders, right? But the term trading doesn't refer to time frame. It refers to a philosophy about what you're doing with your money. Okay, a trader, for example, doesn't care about the usual things that an investor does. Probably the single biggest difference between a trader and an investor is that investors have hope. They have faith that whatever they're in will work out. So consequently, they'll often put on what starts out as a trade, but then it doesn't work and works against them. But they'll hold on to it because they have faith in the underlying gizmo that the company has. Traders have no faith. Traders want results. Okay, for them it's about results, not about being right. Okay, you have to understand that if you're trading as a business, I can promise you. I mean, of all the things that I cannot promise you, I can promise you that you will have losses. Okay, that's just the nature of the beast. You can do everything right and still lose money on a trade. That's just the way it works. Okay, but a professional trader will know how to keep his losses small and let his winners run. Whereas an investor, he will ride that investment all the way down to zero. Now, that's because we're emotional beings, right? And you have to struggle against that as a trader. You have to, and that's not easy to do. Okay, that is the inner sanctum, okay, of trading, is getting to the point where you can lose money on a trade and be perfectly fine with it. But there's a very important caveat here. That is, if you did everything correctly, if you did everything right and you lost money on the trade, that's fine. But if you broke rules and you lost money on the trade, then you better be aware of it, and you better acknowledge it, and you better own up to it, and you better learn from it. Okay, so if you do everything right and you lose money on the trade, perfectly fine, it's going to happen. If you do everything wrong and you lose money on a trade, well then, yeah, you got some self-reflection to do. Okay, now the way you judge success as a trader, ironically, it's not monetarily. Successful trading is not based, your measure of a successful trade is not based on how much money you made. It's based on whether you traded well. Did you trade well? Did you do the right things? What I mean by that is you could do everything right. You could find a nice trade setup. You bought it at the appropriate time. You put your stops in, blah, 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 and it didn't work. Boom. Okay, you lost money on that trade, but it's still a good trade because you did everything right. On the other hand, if you broke all the rules, okay, and you got shit ass lucky and you made a boatload of money on a trade, okay, that is not a good trade. That is a bad trade, because you can get away with that from time to time. You can get lucky, but luck is not a reliable tool. And if you are going to rely on luck as a trader, you will not last. You will go bankrupt, I promise you. So those times when you do get lucky on a trade and you make a lot of money, do me a favor and be a little bit humble and maybe say, you know what, I'm glad I got away with that, but boy, I better not make that a habit. Okay, it's very important that you develop the proper habits if you're going to be a trader. All right, what's next on the list? Trading as a business. Okay. Okay. Now, why should someone trade as a business? What are the advantages and disadvantages? Well, all businesses involve, risk, right? All right. So let's get that out of the way. But with typical, with trading, you don't have the typical problems that you have with a regular business. With trading, it's just you and the market, right? So what do you need to trade? You need a computer, you need internet access, you need a trading platform, and you need some dough, you need some trading capital. Well, I can't help you with 3 out of those 4, but I can help you with the education part, learning what to do. But that's it. Now, what's your overhead when you're trading? Well, you got your capital. Okay, so you put that up, but you would have that with any business, right? You put up your capital, to trade. But then your ongoing expenses, okay, well, you might have commission fees, and you might have an accountant to pay at the end of the year to help you with your taxes, if you want. And what else? And you need to pay you have to have an internet feed. Okay, well, you probably have internet anyway, if you have cable TV, so that probably doesn't really count. So about the only really 2 expenses involved are your trading capital, your upfront capital, and your accountant at the end of the year. Now, if you want to get an office to rent, okay, then you got that office space, for that. But you can do this from home, right? But yeah, okay. So if you get an office, you have that. So, but if you have other business, let's say you own a pizza joint in Brooklyn. My son, by the way, owns a pizza place in Brooklyn called Randazzo's Pizza on Ditmas. So if any of you are nearby, go in and say hi to Vince and tell him you saw this video. And he's doing really well. But I know the kind of moving parts he's dealing with. But if you have a restaurant, you have all sorts of expenses and things to keep a handle on. It's complicated to be a small business owner. If you're a small business owner out there, you know exactly what I'm talking about. There's always something, right? With trading, you set up your account, you learn a few things, and then it's just you and the market, my friends. That's it. Very few moving parts in trading. So that's one big advantage right there. Another big advantage is you can control your risk. Now, if you, again, if you're a restaurant owner and everything's going along just fine, and then somebody chokes on a chicken bone, and then you got to deal with that lawsuit that came out of nowhere, right? So you have things that come out of left field in almost any business you run. There are things you cannot control. With trading, you're in complete 100% control of your risk. All right, that's another big advantage, right? Liquidity, right? If you own a business and you want to cash out, you want to sell it, okay, you got to sell the darn thing. And if it's not a profitable business, you might not get that much out of it or whatever. With trading, you put everything to cash and you're done. So so another reason why, another advantage to trading as a business. Now, why doesn't everyone trade for a living? Beats me. Well, no, but look, trading is difficult. Okay, but if you do what I teach you to do, trading is simple. But there's a big difference between something being simple and something being easy. So trading, if you do it right, is simple, but that doesn't mean it's easy. The hard part is between the ears. Okay, it's the psychological part, and that's the hard part. That's the challenge. Okay, but what I try to do is the best I can do for people is show them a few simple techniques to use, the general rules of the road, a few ideas, tricks of the trade, and then have you figure out your own personality, put your own stamp on what I teach you. All right. So I got to be careful not to bloviate because I love trading so much. Sometimes when I get onto a topic, I can blabber on and on and on. I can talk to a mailbox for an hour about trading if the mailbox sits still long enough. So let's try to move along here. Okay, let's talk about some misconceptions of trading. Okay, the first misconception is that education is not required. I can do it. I'll watch a couple of YouTube videos and I'm good. Well, if you don't learn from an experienced trader, someone who knows what they're doing, you're gonna learn in other ways, in a lot more expensive ways. Okay, so get educated. Whether you take my little 90-minute course here, which I don't do anymore, by the way, because I'm happy with what I'm doing. I trade my own account and I'm doing other things with my life right now, showing people how to make passive income in a few opportunities. But learn from someone who knows what they're doing. So whether you learn something from me or you learn something from someone else, I don't care, or you read a book, I don't care where you find your ideas about trading. But once you find something that works, okay, play it out. Don't jump from one shiny object to the next shiny object. You got to settle eventually on something and become really good at it. Become really good at one or two things and then just do it every day. And that's when it's a business, right? Okay, another misconception is that profitable trades are accidental. No, they're not. We just talked about that. When you make money on a trade, you want to have made it because you did the right thing. You intended to do it, right? You had a plan, and there's a reason why you put on the trade, and the reason worked. Okay. Another misconception is access to news ensures success. Boy, is this a big one. Nowadays, everybody, when I was trading, we didn't have the internet, now everybody is just flooded with, you can go on the internet and it's unbelievable the amount of information you can get. And they think, oh, that'll solve all your problems. All I have to do is watch the internet every day and I'm golden. Now, you got to know, you got to become a discerning consumer of that news. And that'll take time. Most of it is garbage. Most of it is useless. So please don't think that that's going to solve your problems. Another misperception is that success is measured by profits. We talked about that. No, profits is the byproduct of trading. If you trade well, okay, the making money part will take care of itself. Okay, so your focus is on trading well, not on making money. Ironically, right? Trade well, and the making money part takes care of itself. And part of trading well means taking losses. Okay, you got to learn how to take those losses. Probably the first thing you have to become good at, again, ironically, is taking a loss. But the idea is keep your losses small, let your winners run, right? Okay, we're going to cover that more later on. All right. Discipline is not necessary. Oh man, discipline is talk about a central characteristic of a successful trader. Discipline, and boy, we'll be getting into that more. I promise you. And the last misconception people have is that you think that you're trading a stock, or you're trading a cryptocurrency, or you're trading this or that. No, you're not. You're trading people. The market, I don't care in what iteration, whether it's stocks, bonds, cryptos, doesn't matter. You're not trading that product. You're trading people, and people are emotional beings. That's why the marketplace is never going to be a predictable, orderly place. There's nothing orderly about human emotions. Okay, human emotions is boy, it is a rat's nest, right? So trading is never going to be orderly. It's emotional because it's made up of human beings. So what I'm going to be teaching you how to do is not how to trade stocks or cryptocurrencies. I'm going to teach you how to trade people. That's the key. And boy, I got really nice tricks of the trade. I don't know whether I'll get to them during the course of my class here or not, but stay tuned. All right, what's next on the list? Characteristics of a successful trader. All right, got discipline, and discipline can be cultivated. Okay, it can be learned. Okay, you can, if you think you're too emotional, if you're determined, you can do it. If you think you can't lose those last 10 pounds, you just have to learn to live with it. No, you can lose it. You just have to do the right things, and you know what those things are. But it just comes down to discipline, right? Patience. Now, there's kind of a stereotype out there about traders, sitting at the keyboard, usually in their pajamas, pounding on their keyboard, 100 miles an hour with their hair on fire, right? And that's their image of a trader. But no, actually, a good trader is patient. Usually, if you were to see me trading, many times I've got my feet up in the desk and I'm watching a John Wayne movie because I know what I like, I know what I'm looking for, and I'm being patient, waiting for it to come to me. Let the trades come to you. Don't go chasing down trades. You should know what you want ahead of time, and then you wait for them to come. And if it takes a while, that's perfectly fine. There's no rule that says you have to be in a trade all the time. I think most of the time, you're better off not being in a trade. And for those of you who have any experience as a trader, you know exactly what I'm talking about. Okay. Attitude. Attitude is important. When you go into trading, you have to go into it not thinking that you can do it. You have to go into it knowing that you can do it. So whatever mental gymnastics you have to go through, that's the attitude you want to have. You want to be, remember, it's you and the market. Okay, when that gladiator goes into the ring, he better be in the right frame of mind, because this is a matter of life and death, right? So he puts himself in the right frame of mind. As a trader, you got to put yourself in the proper frame of mind. And that means you have to know that you can do it. Now, if you have self-doubt, then figure out why you have self-doubt. You think, well, maybe you don't understand these patterns well enough. Okay, well, do some more studying. Or talk to somebody. But somehow you got to find a way to get to that place mentally where you know you can do it. Okay. All right. Aggressiveness. Okay. Now I just talked about the importance of being patient, ways and trades that come along, but you do have to have an element of not combativeness, but of aggressiveness. You know, when you see a trade, let's say you set up parameters. You say, okay, when that stock breaks above that channel, I know it's a buy. Okay, and since you predetermined that, right? When it does happen, push the damn button. Okay, one of the big problems is people in trading. People are too conservative. They're too safe. And they end up taking more risk than the guy who knows when to push the button. So, but the way you handle that is you pre-plan your trade, right? You don't act on. You don't want to be reactive. You want to be proactive. All right. So when you see, so you want to say ahead of time, all right, when the stock does this, when the cryptocurrency does that, that's when I'll buy. And then you wait for it to happen. But when it happens, push the damn button. Boy, I wish I should make that a button, because for my shirt. Because I mean, when I was a trader, many times I'd walk up behind one of the students, and he's looking at a beautiful trade, and he's thinking about it, and I'm saying, push the damn button. It became kind of a running joke in the office. I'd be walking down the hallway and someone would yell, push the damn button. Yeah, that's good. But that should tell you something. Okay, let's talk about the best ways to lose money as a trader. Okay, all right. This is important stuff to know. I mean, you want to know this stuff, right? I mean, what's the best way to lose money? Well, I'm going to tell you a few. Okay. One way is to trade stocks that have no volume. Again, this goes with all products. I mentioned stocks, but it goes for everything. So some people like to look for that little out of the way stock that nobody else knows about, but they want to own it before everyone else knows about it, right? So they're going to buy it now while it's only doing, 100,000 shares a day. So, because they know more than the street, right? They've got the inside scoop of this guy. And eventually Congress is going to pass something that's going to make this thing skyrocket, or the FDA is finally going to approve the guy. And I want to own it before that happens. Well, okay. 1 out of 100 of those might work. But if you do that, just understand that you're not trading. That's not trading. That is not even speculating. That's guessing. Okay. So just don't confuse the two. Okay. So don't bother with trading vehicles that have a low volume. You don't want to be the only one watching the guy. I promise you, that is a losing game. Next, another way to lose money is you can enter trades too late and you chase the stock. That goes back to being aggressive, right? So that's called chasing. So let's say a stock breaks out and then you wait a while, and then it runs up a lot, and then you decide to buy it. That's called chasing. You don't want to chase. Another good way to lose money is you can exit trades too late. Okay, and that's being greedy. You get in, you got a ton of dough, but you hang out there and you hang out there and you think you're going to make $1 million on that trade. Then it turns around and heads south. Exiting trades too late. Another good way to lose money is think that you know more than the market. Well, good luck with that. Okay. One thing you better come to terms with right now is that the market is always right. Okay. Now, as I'm making this video here in November, in late November, almost to Halloween in 2021, the markets are doing great. The economy is in shambles. There are a ton of I can give you a long litany of reasons why this economy is in serious trouble. But the market is still strong, and there are reasons for that, ironically. But if you started shorting this market, a few months ago, because you had an opinion that the market could not sustain this, well, then you're not very happy today, because if you shorted the market, shorting is a way of making money when the market goes down, right? You're betting the market go down. So if you shorted the market right now, you're not very happy with yourself. The market doesn't care about your opinion. Okay, there are a lot of reasons why the market and stocks and currencies and commodities go up and down. Okay, and just because you think you figured out a nuance that no one else has caught on to yet, so boy, man, are you smart? The market doesn't care. The market doesn't care about your opinion. The market is always right. Never argue with the market. So you got to learn to read the market and do what the market is telling you should do, not what some talking head on TV is telling you to do. Now, look, a little bit of a segue here, but this is an important topic, okay? For every analyst, highly respected, that's on TV, giving you his opinion about something, I can find you an equally respected analyst giving you the exact opposite opinion on that very same topic. Okay, so don't become inured. Don't drink the Kool-Aid. Don't do things just because some guy on TV or YouTube tells you should do it. You should always look at what the market is telling you. What is the stock telling you? And look at the charts, because in the end, that is what's going to make you money. And toward the end of my class here, that's where all the money-making stuff is taught. I'm going to show you how to find what you really should be looking at. So, all right, enough bloviating on that. Okay, another good way to lose money is to fight the market trend. Well, we just talked about that. Don't fight the trend. The trend is your friend, right? That's what I was taught in the early days. Okay, and another good way is to speculate on rumors. Do not speculate on rumors. Now, it's okay to listen to rumors and check them out, but always wait for confirmation in the marketplace. Say, but don't just buy something just on the rumor itself, because 8 times out of 10 those rumors are bogus, or that rumor has already been built into the stock price. I mean, listen, let me tell you something. If you are hearing the rumor, okay, it's old news. Okay, I promise you that that the only people who made money on a rumor are those people at cocktail parties, and they're lying to you. Okay, by the time you hear a rumor, it's old news. The smart money already knows that stuff, and if you come to terms with that, you'll be much better off. Okay, all right. Next, ways to succeed as a trader. All right, do not let a big profit turn into a small loss. All right, you have to, if you are in the habit of getting into a trade that runs really, really far, but then you hang on to it just long enough to lose it all and it goes into a loss, you're not going to last very long. You got to find a way to avoid that. And later in the course here, I am going to show you a way to avoid that. I'm really good at this stuff, by the way. So also, another good way to succeed is keep your losses small. I can promise you, you're going to have losses, but keep your losses small. Okay, discipline, right? Okay, leave your ego at home. Okay, your ego, and again, it's easier said than done because we are human beings. But that again, that's the inner sanctum. That's the holy grail of trading, is getting to that point where you can lose money on a trade and be okay with it if you did everything right. Okay, but it's easier. It's easy to say right now. You're nodding your head. Yeah, that makes sense. Well, wait until you're in there. Okay, and the thing is, as human beings, we tend to equate a loss with failure. Okay, we make it personal. I think the number one reason, well, the reason why people don't take that loss when they know they should, they can know academically that they should be taking that small loss, but they can't bring themselves to do it. That is because they think that when they sell that at a loss, somehow they failed. And so they internalize that, they make it personal. And that's what I mean by you have to learn to keep your ego at home. Again, easier said than done, but that is the objective. And most people cannot do that. And that is why most people don't make it as traders. Okay, you find me a successful trader, you show me a successful trader, and I'll show you a guy who knows how to take a loss. Okay, another way to succeed, buy the dips and sell the rips. Again, buy the dips, sell the rips. You're going to hear me use that phrase a lot. I just wanted to throw it out there. So, you can buy a dip, that's self-explanatory, and you sell the rip. A rip means a big move up, okay? So you will, if you end up trading professionally, you'll learn how, you'll develop a knack for when to do it, and we're going to talk about that later in the class. And finally, a way to succeed is learn from an experienced trader. Now, I don't do this anymore. If someone wanted me to teach them now, they would have to shell out quite a bit of money because I'm happy with my life right now. But that's what I spent a lot of my life doing, is mentoring people and teaching. And most of it is psychological because and almost if they're one of my students, they already know what they should be doing. And then it's mostly post-mortem stuff. And we look at a trade and say, well, why did you do that? Why did you? And they usually know the answer. So then it comes down to, all right, well, let's get your head straightened out. But my point is, learn from an experienced trader. And that can mean reading books. There are a lot of really good books out there, on trading. Looking for some good online trading courses. I do not have one. I thought about putting one together, but I think this is the closest I'm going to get. I am used to doing my courses live and in color, in person with people. That's why I haven't done these online videos on trading before, because I didn't know whether I could really do it justice, and I don't think I really am. I think it is better, doing them in person. But just for the sake of answering the call out there, the request other people are doing, that's why I'm doing this. But learn from an experienced trader somehow, if you can. And if that means selling out a course, and the good ones, and they cost a pretty penny. They could cost up to $5,000. All right. But remember, if you want to do this for a business, that's actually kind of a small price to pay, right? When you think about it, if you want to open up a restaurant, how much money are you going to have to lay out just to get permits, right? So keep things in perspective. Okay. So a good education can pay off a lot. You have to decide how serious you are. How badly do you want to do this? I mean, the payoff can be enormous, not just monetarily, but also the freedom it gives you. As a trader, once you have your trading style, you can do it from anywhere in the world, right? I should have mentioned that in the opening. One of the advantages of trading is you can do it from anywhere. As long as you have an internet connection, you could live the laptop lifestyle, as they call it, if you wanted. All right, what's next here? Am I going on too long for you guys here? Let's go over some basic terminology. Okay, you got the scalper. Now, scalpers look for very small but very fast profits. Then you got the trend trader. A trend trader will stay with a trade as long as the trend stays intact. And a position trader refers to usually a longer term trade. They're putting on a position. That is basically investing, right? If you're a position trader. But again, the difference between trading and investing is not one of time frame, it's one of philosophy. I think that everybody should be traders because of the philosophy involved. Investors are willing to be wrong. They're willing to ride their investment all the way down to zero because they become emotionally involved in the trade. Okay, traders don't give a damn, like what we just covered. All right, some other terms. Long. If you're long a stock, that means you bought it and you want it to go up. If you're short a stock, you want it to go down. As a trader, you can make money in both directions, right? Investors, by the way, that's another difference. Investors can only make money in one direction. They buy a stock at a certain price, and they want to sell it at a higher price. Traders can make money in both directions. The way a trader makes money on stocks going down is by shorting. Again, this refers to cryptocurrencies, all products, right? Okay, bulls and bears. Okay, bulls expect the market to go up. Bears expect the market to go down. Think of it this way: if you're brand new, you're learning these terms. Think that a bull charges upward, right, and a bear sits down. That's the way in the early days. That's how I remembered it. Bulls and bears. The bid and the offer. Now, the offer is often referred to as an ask. Now, when you're buying and selling stocks, commodities, cryptos, whatever, they all have what they call a bid price and the ask price. Ask is also referred to as the offer. All right. Now, the bid price is the price at which someone is willing to sell, okay, that product. And the ask price is the price at which someone is willing to buy that product. Actually, flip that. The ask is where someone's willing to sell, the bid is someone is willing to buy. But basically, you have two prices, right? And to buy and sell. So if you want to sell something, you look at the bid price, and usually there's a list of bid prices, and the highest bid will always be at the top of the line. All right, so you can see what the bid price is. So if you want to sell something, that's the price you're going to get, that number that's at the top of that list. And if you want to buy something, you look at the ask price or the offer, and you look at the number that's at the top, and that's what you can buy it for. So in layman's term, the bid and the offer, also known as the ask. Fading. What is fading? Well, fading is when you are actually going against the trend. Let's say a stock is selling off real sharply, but for some reason, because of one of the tricks of the trade that Ed told you about, you want to buy that guy during the sell-off. So what you're doing is you're buying a stock that's going down. That's called fading. You're fading into it. Okay, and if you're selling, same thing. You are selling while it's going up, so you're fading out of it. That's a fading. Fading is going in and out of a trade when it's going the opposite direction. All right, the street. What is the street? The street that's a vernacular for basically the collective out there as a whole. Everyone that's out there buying and selling. We just refer to them as the street. So it's just kind of shorthand. Probably you hear me talking about a stock or a commodity or a cryptocurrency. I might say, oh, well, the street likes this, or the street doesn't like this, or I'm referring to what the collectively, all the investors and traders out there think about that particular product at that moment in time. So the street refers to the collective, okay? The matrix. All right. Some tips from an experienced trader. I wonder if I should just call this the end to this video. All right, let's just do a little bit more. This is some tips from an experienced trader. If you're day trading, trade the opening, okay, of the market and the final 90 minutes of the day. If you're day trading, right? If you're day trading stocks or commodities or whatever. Now, cryptocurrencies and other stuff, they don't have the same time frame, but I'm talking about, for day traders. You want to avoid the middle part of the day when you're trading stocks, because that's where good trades go to die. You have a stock they'll start breaking out, but then it'll fail and go down. So there's a lot of gamesmanship going on in the middle part of the day. So you want to take advantage of where the volume is, where the swoosh is, and that happens at the opening and it happens at the close, like the last 90 minutes. Okay, someday I'll talk to you about trading the aftermarket. Another tip: trade the easy money. Okay, now over the course of time, you're going to learn to recognize what I call the gee whiz trades. Okay, now I can show you academically what chart to look for, but some charts, for example, if I show you the Anderson pattern, okay, if you look hard enough, sometimes you say, all right, yeah, that's an Anderson pattern. I can make sense out of it. I can see but then other times, you say, oh my God, that's a textbook version of an Anderson pattern. Over the course of time, you're going to learn which ones are the gee whiz trades, the really high quality trades, and those are the ones you really want to lean into. Okay, so there's a little trick for you. Okay, so that comes with being patient and being aware, knowing what you want, and then over the course of time, you're going to learn. You're going to find, your spidey senses are going to come up when you see something. Say, oh my God, I know exactly what that's going to do. When you find yourself, when you feel it in your bones, lean into it. Okay, take advantage. Because as a trader, by the way, you're going to make your money in spurts. You're not going to make it consistently. Okay, you're going to make your money in spurts. So you have to know when to take advantage, when to make the hay, right? So, so when you see those opportunities, take advantage of them. Another tip: trade the trend. The market is always right, right? Another tip is follow the rules. The things that I'm teaching you here in this video are not things that I made up, okay? I'm giving you the benefit of my experience. I've got the scars. So now you're probably going to have the same scars when you start trading, but if you learn from me, you're going to minimize those scars. And these are not just lessons that I learned. These are rules. These are the rules that professional traders use. So I'm giving you here the inside scoop, okay, of what the big guys know and that most people out there don't. Okay. Now, again, I'm not trying to teach you everything there is to know about trading. This is just, I'm just doing a couple of short videos, and that's probably going to be it. So you're not going to get the full weight of my knowledge in trading in these videos, but you're going to know a lot more than you did before you watch these videos. So, and you should watch these frequently. This is not complicated stuff, but it's important stuff. If you don't know this stuff, then it's pretty big stuff. All right. So, all right. So, all right. Here's another tip for you. This is a big one. It's never about the news. It's always about the reaction to the news. Okay. The news is never important. I promise you. Look, fundamentals mean nothing. All of you people out there who spend your time reading balance sheets and P&Ls and press releases, it doesn't matter. Okay, I just saved you so much money on buying books about fundamental analysis. Do not waste your time or money reading books about fundamental analysis. It does not matter. Fundamentals do not matter. And you know why? Because there's only one thing on the face of the earth that moves the price of the stock, and that's buying pressure. Why people are buying and selling, I don't really care. And I'm going to get into this into part 2 of this series. I don't care. The only thing I need to know is that they are. So fundamentals do not matter. So when a piece of news comes out, it's not the news that's important. It's the reaction to the news. What do I mean by that? Let's say that a company comes out with a really good earnings report. Okay, it blows away the street's numbers. But the stock's reaction is, it might go up a little bit, but not very much. Maybe even goes down. That is a big warning sign that everyone who wanted to buy that stock has already done it. And I'm looking to short that guy. All right. So the news is really good, but the stock had a reaction. Maybe even sold off on that news. On the other hand, let's say a stock had a piece of what you would think would be bad news. Maybe they missed their earnings projections by a substantial amount, but the stock doesn't go down very much. Maybe it even goes up on that news. And people are out there saying, well, why isn't the stock going down? That's terrible news. Well, could it be maybe that the street anticipated that news and that stock got washed out ahead of that news? Okay. So it's never the news that's important. It's the reaction to the news. So take note of whatever the news is, then look at the way the stock is reacting to it, or the cryptocurrency or whatever. Okay. So it's never the news, it's the reaction to the news that's important. How's that for a nice tip? Okay, another one. Stocks go down faster than they go up. Statistically speaking, stocks go down 4 times faster than they go up. And the reason for that is because of the 3 emotions that drive the markets. The 3 emotions being fear, greed, and complacency. The most powerful of those emotions is fear. That's why stocks will go down faster than they go up. And the last tip is my theory of relativity. Now that actually refers a lot to about something in the news. Okay, so when you have a stock, and this is an Ed Anderson special, okay, and I use this one a lot in my trading, and I call it this Ed Anderson's theory of relativity. And this is going to be my last tip of this video, I think. This has been going on long enough here, enough punishment for you guys. When a stock does something other than what it should be doing at any given point in time, that move is even more significant than otherwise. Now, what I mean by that is, let's say that a stock has a piece of bad news, okay, so it should be going down. Instead, it's going up. Okay, so on that day, because it should be going down, but instead it's going up, that upward move is much more significant than on a typical day. Okay, so you want to look for events where a stock is doing something other than what it should be doing based on news or whatever. And when that happens, take advantage of it, because that usually indicates a really good short-term opportunity for you guys. Okay, now I'm going to end it here. This is part 1 of my Trading for Dummies series, and I'm going to get into part 2. I don't know when I will post part 2. Maybe if I get ambitious, I'll do it today or going forward. I don't know how valuable these videos are going to be for you guys out there, but I'm doing it just to scratch an itch for some of you out there. Then I'm going to move on to my usual topics, which is passive income ideas, which involve a lot less work than trading. But for now, Edward Anderson on the Hey Ed YouTube channel, signing out.
Copy that.